this out. Europe's stocks banking index was down 4.2% and set for the biggest one-day slide since early June, with declines for major names, including HSBC, which was down 4.5%, and Deutsche Bank off 7.9%. First, I want to thank, we've got 700 people on the live stream and 145 people hit the thumbs up. Thank you so much, because every time you hit the thumbs up, it gets this information out. It literally forces the algo. Last night, 1/3 of the people watching hit the thumbs up and it pushed that video out. Thank you so much, because a lot of these videos get held back because, and I'm going to share it with you in a second, the reporters that were asking these questions in 2005 and 2006 from our financial regulators, and they were lying to you. And I want people to understand that if somebody goes to college, gets their PhD in economics, writes books on economics, becomes the head of the Federal Reserve, they know more because they have access to the real data before people like us do. They know way more than me. But yet there's someone like me out there saying real estate's going to crash. I've been talking about that for, well, a year and a half, talking about all these other market dynamics, but that means they're actually just hiding it from you. While they're getting out of the markets, their buddies are getting out of the markets, you're fully divested. You're invested in your 401k. You're invested in the stock market. You put all of your eggs in one basket. The sad thing is, and I'm going to go off on a little tangent here, as this collapse happens, and it's going to look really scary for the next couple of weeks, and then it's going to get better. It's going to get better, and that's what people don't understand, but it's still there, and they're going to paper over it, and it's not going to be a lasting effect, and then it's really going to crash. Okay, so I want people to understand that this is not financial advice. I'm not telling you to pull your money out of the stock market. This is one thing that blows me away. Do you know how many people have $1 million in their 401k, and yet they owe $300,000 on their mortgage? Think about that. Think of how crazy that is. And the reason why I say it's crazy is because I know people right now that cannot retire because the amount of their retirement, their monthly amount, isn't enough to cover their bills, including their mortgage. And there have been people that I've talked to, and on consulting calls, I'd sit there and look at all their debt. And I go, well, let me ask you this. If you were to pay off your house right now, could you retire? And they look at the numbers, they go, well, yeah, but, and it's that but because they don't understand how simple it is when you're out of debt, core debt. I'm talking about your family's debt. Your cars are paid off. Your home is paid off. I'm not talking about using debt to make money. We talk about that in other videos. I've talked about that in the real estate course where it's really good. You use other people's money to leverage and make money. The problem is people are leveraging their personal lives. Your personal life should be, now this is financial advice, debt-free, wrapped into the proper legal entities like a trust, like an LLC, different types of entities that are out there that you go find professionals and attorneys and accountants to show you, then it's protected. Then you use debt in the proper entities to explode your wealth. But if something happens over here, because debt can cause death and destruction if not used properly, your family is protected. See, that's the problem with our country right now. We care more about impressing people we don't even respect. Oh, look at my new handbag. Look at my sweet car. Look, guys, I was literally drooling over a Porsche GT3 the other day. I'm going to be buying one, right? But I'm not going to buy one at this price. And you'll see it in real time. I'm going to negotiate prices with cars. I'm going to wait for this auto crash. I'm going to do it right in front of you as an example. I want it. Do I have the money for all this stuff? Yes. Why not wait? Why not pounce on the real estate market when it's literally max mortgage rates and the banks are freaking out? Because right now, banks are having trouble all around the world, not only because of an FTX cryptocurrency collapse, they can't make loans. Remember, one of the main ways outside of factoring, and if you don't know what factoring is, we'll do a video on that. One of the main ways that banks make money is loaning money out. And of course, charging you excessive fees. But by and large, do you think that banks can make loans right now with high interest rates? No, they can't. There's going to be more pain. Those rates are going to go even higher. You want to buy your real estate at max pain with the mortgage rates and depressed prices, and then wait for the Fed to run in and start a multi-year lowering of rates. And then as the rates come down, refi, and you watch your prices go up because all the other people around that weren't caring, not ready, they're going to dive right back into the housing market because they want to impress people they don't like. See, it's a vicious cycle. What movie is that from? It's a vicious cycle. Here we go. U.S. lender SVB Financial Group scrambled on Thursday, we talked about this last night, to reassure its venture capital clients their money was safe after a capital raise led to its stock collapsing 60% and contributed to wiping out over 80 billion in value from the bank shares. Let me put a little perspective into this. We all know that quantitative easing lasted forever and took up tons of money. As a matter of fact, most people don't know this. The Federal Reserve announced last February, I believe it was, the official last purchase of mortgage-backed securities. Now think about this. They had been purchasing mortgage-backed securities to uphold the housing market, which allowed banks, when they know, hey, Daddy Fed is backstopping the mortgage-backed security market, literally since 2008, all the way till last February. Think about this. This is what most people, you're never gonna see YouTubers talking about this because they didn't live they weren't invested in the last crash. As a matter of fact, try and remind me, and I'm gonna tell you a story about that guy with the Porsche GT3 last night that I ran into, very wealthy person, and a story we talked about in real estate. When that crash happened in 2008, the Fed started buying mortgage-backed securities to uphold the market. When the banks sit there and they go, hey, we're good to go. Daddy Fed is gonna buy all of our crap mortgages that we make to people, so we can get a little risky with our mortgages. You know, oh, you have a less than perfect credit score? You know what, we'll give you an 80% loan to value. Shoot, we'll give you 10%. You know what, the heck with it. We're gonna give you 5% LTV on that. Yeah, you deserve it. You deserve it. And so we're gonna give it to you. We're gonna charge you a bunch of fees. We're gonna give you the mortgage, and then we're gonna sell that, wrap it into a package of other crap, other financial crap, and we're gonna sell it to Daddy Fed, and they're gonna put it on the balance sheet. The Federal Reserve has been doing this since 2008 and just ended in, I think it was February or March of last year. Now, what happened to rates really in earnest? They started to lift in June, 2 Junes ago, just barely. They're still just right around the 3%, right, for a 30-year fix. But it wasn't until after the beginning of 2022 that they really started to move up. First off, the bond market started to move up in anticipation of the Fed finally in March picking up the federal funds rate, right? So the bond market told you where it was going. But then it really started smoking up higher in the spring of last year. A lot of the reason is because banks went, what do you mean you're not going to buy our crap mortgage-backed securities? What, really? You've been doing this for like 12 years, 14 years, bad math. Okay, you want that loan? You know what? You're going to need a little bit higher of a credit score to get a loan to value of 85, 95%. Sorry, my Daddy Fed is not serious. Okay, we're going to need to tighten up some standards, and we're going to have to add some fees. That's what happened. And most people don't understand that. So when banks go into a tightening because their daddy daddy wasn't there to buy my MBS, take me to the fair. What movie? Sorry, I'm just breaking into song. This is supposed to be doom and gloom, but it's not doom and gloom. When you see these cycles and how they move and how they're normal, and these cycles, when you look at the big macro picture, you have to look back on a 10-year market cycle, because markets go in and out of recession every 7 to 10 years. It's almost like you could set a date to it. It's called the Jewish calendar. It's called the Shemitah. Anyway, sorry, that's not what this video is about. So when you start seeing these big things and banks tightening, this is what happens, all right? Banks, for the last 10 years, have been running away with volatile bets. They've been risk on, they are jumping into it because they had the backstop of the Federal Reserve and the ECB, okay? Now, that's as much as I want to share with this. Now I want to share this part with you. Let me move this. Now this is what's really cool. Like I said, most people on YouTube or social media, they were not invested in the real estate sector prior to 2008. A lot of people in the sector now, because the Federal Reserve has caused just a blissful time of easy money to cause these markets to just pump, and that's what they want to do. People have speculated, both banks and retail investors have dove into the markets. And there's a lot of people on YouTube, they make like $10 million a month. So there's a lot of them that make about $1 million to $3 million a month. And it's because they've been diving in with this cheap money. So this is an example, and I'm going to play it for you. And this is an interview from July of 2005. Now, remember, I tell you, I was selling and racing for the hills, trying to liquidate everything starting in mid 2005. And it was because of conversations like this. Now, this is Ben Bernanke, at the time, the current Fed chair, and Maria Bartiromo. It sounds funny, but I've actually referenced these interviews before on CNBC, and people would comment like, "It shows what you know. Maria Bartiromo doesn't work for CNBC." I mean, that shows you the thinking of some individuals, even the investors. They don't even know where the reporters were working when this crash happened. Why? Because they were still in elementary school or maybe just past getting out of college. So here's the interview. I'm going to try and play it for you. This is some high-tech crap going on right now, just so you know. Editor, let's play the video.
Tell me, what is the worst case scenario? So we have so many economists coming on our air and saying, oh, this is a bubble and it's going to burst and this is going to be a real issue for the economy. Some say it could even cause a recession at some point. What is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices at a nationwide basis. So what I think is more likely is that house prices will slow, maybe stabilize, might slow consumption spending a bit. I don't think it's going to drive the economy too far from its full employment path, though.
So would you agree with Alan Greenspan's comments recently that we've got some areas of the country that are seeing froth? Not necessarily a national situation, but certainly froth in some areas.
You can see some types of speculation, investors turning over condos quickly. So those sorts of things you see in some local areas. I'm hopeful that I'm confident, in fact, that the bank regulators will pay close attention to the kinds of loans that are being made, making sure that underwriting is done right. But I do think that this is mostly a localized problem and not something that's going to affect the national economy. This scenario envisions that consumer spending.
That video gets a lot better, actually. You should go watch that. It's entitled Ben Bernanke Was Wrong. Reason why you need to know this is because in 2005, there was actually a banking crisis. And I got to take some time and find the interview. But we actually had a banking crisis in 2005, and most people don't realize it stemmed from Germany's economy collapsing. It was in utter shambles, and they needed bailouts. So central banks around the world, well, primarily the Bank of England, the ECB, the Federal Reserve intervened to help build Germany's banking system back up, right? Their economy. It was ironic that in 2013, I believe it was, when Cyprus was collapsing, the Eurozone was in a lot of trouble. Germany was the ones that were the bullies, saying, no, we want this, you want this, and we want all of this. Like, you shouldn't even be in our group. They're trying to just destroy these small countries like Greece and Cyprus, and nobody was calling them out, saying, you guys collapsed in 2005, which led to the tip-off of the MBS crisis in America. Most people don't understand how that worked. And now you're seeing it in real time, and that was the whole point of this channel, was to document this collapse. It is going to be the biggest one next to the Great Depression, but it will be sharper and stronger and faster than what happened in the buildup of the Great Depression. Remember, it all started from a flu in 1918. That led to a depression of 1920, the roaring 20s of easy monetary free money, pretty much. Then the crash of 29 and the Great Depression, right? Well, that exact cycle is playing out right now from 2008 to now. Okay, so we're in the Great Depression cycle, and things are just getting times compacting. Most people don't realize that. But what it means, it's going to be sharper. It's not going to take 14 years to recover like the Great Depression did. Why? Because of the technology advancements and what they're about to push out in July, a central bank digital currency.